Welcome back. Today we will talk about the risk profiles of the options. As we know, options are derivative instruments because the price of these contracts is not independent but derives from the value of the underlying of the option contract. There are, in fact, stock options, ETF options, index options, currency options, etc. In this video, we will deal with the risk profiles of the so-called plain vanilla options, which are the most popular. Before proceeding, I must clarify an important issue. Options, unlike futures, are non-linear instruments. This means that the value of these contracts follows the movements of the underlying in a non-proportional way. In other words, the price of the options moves, decreasing or increasing, not only with respect to the movements of the underlying, but also of many other factors or variables that we will talk further. We start with the strategy by buying a call. We take a long position. This long position gives us the right to own the underlying instrument at a certain price that is the strike price within a set deadline and against a premium that represents our maximum risk. It is a bullish strategy that benefits from a rise in the price of the underlying instrument. To examine this payoff, let's now focus on the dark line. Later, I will tell you what the orange curve is. Well, in this case, we have assumed the purchase of a call at a strike price of $1,000. On the market this call is sold to us $40. Well, these $40 are the price we pay to take an upward position on the underlying, starting from $1,000. That is, instead of putting $1,000 on the desk to buy the underlying directly, we simply invest $40 and we buy ourselves the right to be upwards, starting from $1,000. $40, if you think about it, is also the maximum risk of our position. Let's try adding the long future payoff line in gray. You see, if the market falls 90 points of the underlying, with the long call, we will lose only $40. While if we had the underlying in our hands, we would have lost $90. This is valid, even if the underlying falls by 500 points. In the case of the long future, we would lose $500. In the case of the long call, we will always lose $40. As you can see, in fact, the dark line is flat at strike 1,000 and so down to the zero. And if you notice, for the strike you bought starting from 1,000, the dark line begins to rise towards infinity. So a question now. In your opinion, at the expiration of the option contract, if the value of the underlying will exceed 1,000, would you think we make a profit? Well, at the expiration of the call, we will profit when the strike price is 1,000 plus the premium paid of $40 that must be added. This is a sort of an insurance. In fact, we will start to earn as if we were holding the underlying from 1040. This is why the dark line intersects the zero at 1040. From 1041 onwards, we will earn €1 for each point, as if we had bought the underlying at 1040. The advantage of having a fixed maximum loss of €40 and a potentially unlimited profit obviously has its cost. As you have seen, an orange line also appears in this graph. This line differs significantly from the dark lines of the payoff and does not have a linear profile, but curved. This line is called at now. Unlike the dark payoff line, which tells us what will happen to our portfolio at expiration date, it represents the here and now of our position. That is, it represents the gain or loss with respect to the option price in this moment. As already explained, an options contract is a stand-alone, and its price is based on the underlying instrument. So, if the underlying price changes, the price of the options contract changes as well. So back to our example. If the underlying moves from 1,000 to 1040 today, the option contract will no longer be worth 40, but it will be worth, I tell you, 64. And then we will sell the call on the market. We will thus profit $24 with an investment of $40 equal to 60% of return. Not bad. Of course, if we had bought the future, we would have made a profit of $40 and not only 24, but we would have exposed ourselves to a greater risk of loss, as we have seen before. Let's say more. The distance you see between the @now line and the payoff line is the time value. The passage of time will therefore slowly drop the at now line, which will come closer until it covers with the dark payoff line. And this will only happen on expiry. But as long as the option has its time value, the risk profile on which we will have to focus will be almost exclusively the at now curve. But why focus only on the at now? Simply because, in addition to the movement of the underlying, the options live on expectations, fears, and euphoria of the market. What happens in the here and now can be very different from the risk profile assumed by the payoff at expiration date. Let's sum it up like this. The payoff is only what will happen at expiration date, while the at now is what is happening right now to our portfolio and our options. From now on, we should no longer forget this difference. It will stay with us throughout the entire course, and you will truly understand which are the great advantages and opportunities of the options market. From now on, we should no longer forget this difference because it will stay with us throughout the entire course, and you will truly understand which are the great advantages and opportunities of the options market. Let's now move to the opposite strategy of a long call, the long put. We have seen how a long call is used to ride an uptrend movement. The long put strategy does the exact opposite, it rides a downward trend. The long put strategy, therefore, gives us the right to sell an underlying to a third party at a certain price that is the strike price within a set deadline against a premium that represents our maximum risk. Be careful, don't get confused. Long does not mean that it goes up. Long means you buy. So long put goes down and long call goes up. But let's get back to our long put. We also add the payoff of the gray short future. In this example, as you can see, we have assumed the purchase of a put at strike 1000 by paying $40. These $40 will be our maximum risk. We will, in fact, be protected from a sudden rise in the prices of the underlying. But at expiration date, we will begin to earn profits from 960, that is, from 1000 minus the premium paid. Thank you for watching this lesson, see you soon.